a start as we step into the new year this week itself. And it's been very, very quiet there. NBCC, Hindustan Zinc, HFCL, Manappuram, Vedanta, these are your pockets of green. But let's welcome on board Manish Sonthalia as well and find out what he's making of the market, the year gone by and the year ahead. Manish, hi, good morning. What a year it's
Good
turned out to
morning.
be, right? And we were just discussing that FOMO crowd which still wants a piece of silver and gold, and they're willing to give up on their equity allocation. How do you think the year ahead, though, Manish, is going to pan out? And is it going to be this multi-asset strategy which will still work?
So I think FY27 should be better than FY26 for sure. On the back of better macros as far as India is concerned, vis-a-vis what we saw in FY26, and to mention a few, you have very low inflation, you have very low interest rates, and earnings growth is reviving. It's going to be better than FY26, and valuations have corrected. So all in all, I think given the growth and the valuation and the macros, we should be fine. Only thing out here is that what could be the trigger going forward? I think market is waiting with bated breath as to see the light of the day for the US trade deal. I think markets will wait till March or thereabouts, to give some more time. And if that happens, then that could be a trigger point which could lift the markets definitely higher from here. I think earnings growth trajectory is going to be 12-13% for FY27. And you should be seeing in closer to a 15% upside by the end of FY27.
Manish, 12 to 13% earnings growth. Which are the sectors contributing to that?
So it is the usual your banks. They are going to see decent earnings growth. IT is going to be around 6 to 7%. You'll have capital goods. You'll have NBFCs. You'll have healthcare doing quite well going forward. Some of the very high performing sectors for FY26 like metals, oil and gas would be faced with very high base. So we'll need to see as to how each of these individual sectors pair out. But structural sectors are likely to be faring better. Rate sensitive, within that you'll have real estate, you'll have autos, autocoms, consumption, discretionary consumption, premium end of the discretionary consumption faring much better than the staples, because you'll have a problem of nominal growth. You'll have real growth, and volume growth is going to be the deciding factor because you have very little inflation. So these are some of the sectors which will bring about that growth.
But Manish, within sectors that you talked about, there is a lot of churn which is at play, and increasingly, at least off late, it's more the bottom-up stories which are actually coming to the fore as opposed to what the leadership names or erstwhile leaders have done. Do you think that kind of a phenomena is going to play out? I mean, one is seeing that catch-up trade happen in autos, in banks, and of course, IT, the entire sector is moving up.
No, so again, it is to do with valuations. The biggest concern in the market, because the market is very, very deep. The large caps and the mid caps make up around 250 odd stocks, but below that, it is a very large space. And this is the most talked about space. And here, you can't paint everything with the same brush, saying that everything is very expensive and the mid and the small cap universe is to be avoided totally. I don't believe all that. I think it is to do with individual stocks. So out there, bottom-up stock picking is going to be the key. There is no right sector valuation per se that is very, very cheap or very, very expensive. So yeah, what you're saying is absolutely right that bottom-up stock picking is going to be the norm. And valuations have corrected massively. So some of the sectors like rate sensitives have a massive tailwind, like rate cuts, then you have GST cuts, then you have your income tax cut, 1 lakh crore incentive. All of that will be a kicker in terms of boosting consumption. And the proof of that pudding is basically what we are going to see from the third quarter onwards. So again, out here, the automobile space, the GST cut has been massive. You'll see very strong growth going into the future. You talked about tires, the CV cycle is turning. And if the CV cycle turns, you have, and proof of that is basically your rentals, your freight rates have actually started going up, and fuel prices are very, very benign. So in all of that, basically guys who are exposed more to the tire space, particularly the MHCV space, are going to be benefit. So all in all, rate sensitives have a massive tailwind. Government is doing its bit to boost consumption, and that is why bottom-up stock picking will be the norm.
Manish, hi, morning. I remember last time we were talking about what could do well going ahead. You did say that you're concerned about the kind of valuations that we're seeing in sectors like capital goods and railways and defense, again, for that matter. But once again, these stocks, some of the select stocks in these packs have a run up. Do you believe that the valuation is something that the street is not looking at right now, and there is perhaps more legs to these rallies?
Yeah, so the concern on valuation on these spaces still remain. Again, out here, the roads, railways, defense, capital goods. I mean, this whole belief that there are green shoots for the private sector. It's yet to be proven. Of course, there are a few sectors like EMS where PLI benefits, etc., would warrant that you have a lot of capex. But roads, railways, defense, the government's balance sheet is only that much. You have a problem of nominal GDP, 9 to 10% nominal GDP. How much of a revenue collection will you see? 10 to 11%. Within that, you'd have to allocate to roads. Government's balance sheet can only support that much. 3% of GDP is basically the capital formation. It's a good number. So valuations are still very elevated because some of these favored sectors are discounting probably FY28, 29, and no room for error per se. So I would believe these are some of the sectors where you'll see growth, but all of that growth has been priced in. How do you make money buying at these prices?
Okay, so that's the take, Manish. But what's your take on pharma? Largely in the year gone by, and all the sound that we've heard around the US trade deal, pharma has largely been excluded from tariffs, at least the generics bit of it. And India is big on generics. Are you positive on pharma as a sector for the next year?
As long as the tariffs don't get included for generics, we are fine. I mean, India supplies US the most amount of generic medicines, and they can't live without these generic medicines. The healthcare costs are actually going to go up significantly. One space which has seen significant correction is basically the CDMO space on the back of the lingering doubts about the trade deal, what sort of an impact they're going to have on the pharma space as well. Plus your stocking and destocking and delaying and all of that. I think this is one space which is very, very exciting. There is a lot of promise now with the Biosecure Act also coming through. Of course, that is meant for government related work. But nonetheless, the minuscule size of India CDMO vis-a-vis the rest of the world, even if you were to get a shift, a minute shift from what China gets by way of business, there's going to be massive growth. And I would believe that some of the stocks which have seen destocking over the last 6 to 9 months would be there in the base, and thereafter you'll see growth. So more bullish on the CDMO space, both India CDMO as well as the overseas, the new discovery CDMO, plus the GLP opportunity. These are exciting areas in the pharma space where you'll have GLP-1 going off patent from April 26. That's going to be a massive opportunity. I think all pharma companies are very well prepared for that, and we'll see how the growth comes about in that space. So these are spaces in the pharma which look good.
A keen observer of the food delivery and the QCOM space. Now, a lot of interesting developments there. Even as we speak, this weekend, you've got a new entrant into the game filing its DRHP. We were just earlier chatting about that fundraising is really not an issue. They're combined sitting on 40,000 crore rupees worth of cash on their books. Profitability, yes, is still far away. And then there are those huge players with deep pockets like your Amazon India and perhaps Reliance as well. We're waiting on the periphery to get into this game. And then, there are the incumbents, and I call them incumbents now, which are also sort of experimenting into the brick and mortar business model.
Aisha, the total addressable market in this space is very, very big. Both the food delivery as well as your quick commerce. China has 10x the number of food deliveries that we are doing. currently. And basically, India is a story about growth in per capita income and habit formation, and this habit formation is not reversible. That is for sure. And the average order value is also going to go up. So 15% sort of a growth in food delivery is somewhat believable. And till now, we had basically two players, Swiggy and Zomato. And in food delivery, I think these are the two guys which have reserved their place. The third player is going to find it very difficult to, take market share away from either Zomato or Swiggy. Now it's the quick commerce space. Again, the size of the total addressable market out here is 10x the food delivery. And out here, there's a very big fight in terms of how much share which will each quick commerce player would want to have. And there's a right to win for everybody, but there's a learning curve. It's not very easy. Even if you have very deep pockets and you raise a lot of capital, basically the rider economics within a defined catchment area is something which is going to which will be basically very determinative as to who is going to survive in the long run. And out here, the guys who have actually gone through the learning curve, Zomato, Blinkit has actually taught quick commerce to the entire market. Everybody is now following the footsteps of what Blinkit has gone about and done it in the first place. And here they have the right to win. According to me, if the discounting wanes, because today it is buying turnover. You have new players who are giving a lot of discounts to buy turnover. You can buy the whole world giving everything free, but that's not how you make money. So the idea is that you discount less and you make more profits. And out here, basically, it's a limited catchment area. Whoever occupies that catchment area first is the guy who's going to be having the network effect first. And the proof out here is basically open dark stores. And dark stores, everybody is on a massive opening of dark stores spree. And this is where the unit economics is actually going to matter. And I would believe that learning curve is very, very steep in this space. It's not very easy. And out here, there's only one player who basically has a right to win currently.
Manish, how will you, look at the same space given the fact you have the investors at some point in time looking at cash flows from these operations? Today, a large part of their valuation is because of the quick commerce, and that's why they're getting a higher valuation there, not because of the food delivery business, which is now stagnant or saturated in some way. It's maybe profitable on a contribution margin basis or EBITDA point of view, but quick commerce is something which is closely watched out for. And do you think the investors have patience to wait for another few years before they start seeing profitability coming from this business?
So, Ajit, basically, the total size of the retail market is a given. And the fact that consumption is moving differently than what it was 10 years back. Brick and mortar consumption giving way to online consumption, convenience economy is the norm. And I think you're right. The rule of 40, basically, when you are looking at new generation businesses, the rule of 40 actually makes a lot of difference. And at the end of the day, it is basically your cash flows. So you prepare the DCF for all of these companies, and at the end of the day, the net present value is going to make sense, and then only there is value, in the stock price. So the proof of the pudding is that if by 2028 or by 2030, till what point in time you can basically draw the cash flows, if those numbers don't come about, then obviously the stock prices are going to fall. But given that dynamics, and given the growth and the unit matrices of each of these companies, which they are reporting on a quarterly basis, the projected plans, it does appear that there will be positive net profits for at least Zomato by the year 2028. And in that backdrop, the valuations would stand justified. I'm not saying that others won't make it, but clearly this is the guy who will be the last man standing. If everything goes wrong, then Blinkit is going to be the last man standing.
Okay, quite convinced there, but great to have you, Manish, on the show. Thank you so much for your time and wish you a happy new year from all of us.
Happy New Year to you all also.